7 million Americans are more than 90 days behind on their car loans, nearing the peak from the Great Recession. As Tyler Lake reports, it's younger and poorer buyers that are ending up underwater.
Neil Welliver used to sell cars. He started out working for his father, but it wasn't until he left the family business that he saw the more aggressive side of auto sales.
We would have to scrape the customers off the ceiling because when they would see that number, I mean, they would jump up and get physically, you could tell they were very upset at that number.
That was part of a sales tactic called the four-square technique. First, you hit the buyer with a huge down payment, low trade-in value, and an astronomical monthly payment.
And we would basically follow up and say, well, how close to these numbers can you come? And right then, a lot of the folks, when they walked in, were thinking, I'd want to be at $200 or $300 a month. Then they mentally bumped themselves to a higher figure after seeing those large inflated numbers.
Dealers can play with the numbers, lowering down payments, increasing trade-in value, and stretching out the life of the loan until the numbers seem affordable to the buyer. It's one way they can distract the buyers from paying attention to the actual cost of the car. Welliver says if buyers stay focused on monthly payments, they might not realize how much they're spending overall or how long they'll be paying off the loan. When you think about it that way, it's not surprising to hear so many people can't keep up with their payments. Most of the loans that end up in default are from young buyers, those with weak credit, or often both.
You're seeing more delinquencies at the finance companies than you are with the banks and credit unions.
And there's a reason for that.
Banks have to be accountable to federal regulators who are looking at safety and soundness and looking at risk. Auto finance companies don't have that. So as long as they're achieving a return, they can take on more risk.
And that's exactly what those lenders are doing. Half of the loans from auto finance companies are to borrowers with a subprime credit score. Credit unions and banks keep their mix of poor credit buyers much lower. Many of these subprime loans are through buy here, pay here lots that aggressively market to customers with poor credit.
Because you hear those advertisements all the time, no credit, bad credit, anything like that, we can help you out. And then they add the tagline or something like that, we're just here to help you or something along those lines. Well, no. They're not helping you if they're going to help dig you further into debt when you've got something that still works, still gets you from point A to point B. It just isn't as fancy as what you would like it to be.
Schumann says that while dealers may employ that technique to distract buyers from the actual cost of the car, it's up to the consumers to do their homework.
I think people need to be more confident and more prepared to come in with what they can actually afford and stick to it and not get drawn into the let's extend the life of this loan or anything like that.
But people are spending more than ever on used cars. According to Experian, the average used vehicle loan payment tipped over $400 a month last year. Macy says there's a number of reasons for that. One is that people are buying larger vehicles like SUVs and trucks, but she says there's a bigger problem pushing up the delinquency rate.
Our overall sense is that the jobs that we've been replacing jobs with since the recession tend to be lower wage, lower quality, and therefore people are kind of making up for that with debt, and that's putting us in a risky position.
One common way buyers are trying to reduce monthly payments on more expensive cars is increasing the length of the loan.
Marketing being shifted towards people that are buying these cars, they're telling them that they can afford these monthly payments because what they're doing is they're stretching out the life of the loan. So it used to be that car loans were, you could say 4 years. Now we're talking they're going into the 7-year terms.
That makes the monthly payments cheaper, but it leaves the buyer on the hook for a lot longer, often paying on a car that is worth less than what they owe, even years after purchasing it. Schumann says 5 years is as long as he would recommend for a car loan. He also says you shouldn't spend more than 15% of your total income on a car, and you should put 20% down on your purchase up front. And for a lot of people, that can mean setting reasonable expectations and sticking with the plan you make. Welliver has seen firsthand what can happen if you're not careful. He says do your research and be prepared before heading to a dealership.
If you're looking for a certain make, model, mile range for a vehicle, you can compare and know, hey, I'm going to go out and I'm going to probably pay within this window.
For Indiana Newsdesk,